AJ, we're ready to go.
All right, awesome. Again, yeah, sorry for being late, everybody. But let's call this meeting to order, and please rise for the pledge of allegiance. I don't have an agenda. I don't have an agenda in front of me, so I'm not too sure what the order of operation is. I'm just going off of what I'm used to. Sorry.
Let me pull up the agenda for you. There you go.
I think we're
Perfect. Sorry about that, guys. All right, so yeah, Jan, can we do a roll call, please?
Yep. Jake Russell. Scott Darney. Dave Johnson.
here.
Bill Lakota.
Here.
Tim Mankey. Anthony Milley. Virginia Ramos Rios.
Here.
Sam Sharma. John Slazarski.
Present.
And AJ.
Here.
Okay. Have a quorum.
All right. What's next? Minutes from last meeting. Can I get a motion to approve the minutes from last meeting, or is there any discussion or notes on them?
John usually has my notes.
Oh, I'm good.
We just need a motion to approve in a second.
Motion approved. Second.
Okay, we have a motion and a second. All in favor?
Aye.
Aye. Any opposed? Alrighty. All right, motion passed. Moving on, we have public participation. Do we have anyone in the room or online?
Nope, you're good.
All right. Oh yeah, then we'll just move on to new business and hear from our guests here.
Perfect. Thank you. So we have the presentation out in front of us. I hope everyone online has this. We sent it over yesterday. So we're going to start with our policy period experience details. This is on page 3 of the presentation. This is first looking at our policy period claim trends, and this is a graphic that we've shown in the past at past meetings here. The top half being your PEPM claims by policy or quarter. PEPM is per employee per month. And again, these are broken out by quarter. So you can see through March of 2025, we have that claim cost being $1,964. In addition to the PEPM claims by quarter, we have a 12-month average layered over top in that red line. We can see there's a slight increase in trend since January of 2023. We've kind of leveled out since April of 2024. So that claim trend has been relatively consistent across this total group. I will pause and say that these graphs that we're showing here are referencing the total group, town and Board of Ed combined. So that is one piece of this that I definitely want to point out. The next piece on the bottom half is our PEPM, again, per employee per month cost versus accrual. So the cost would be your claims plus your fixed fees. And then the accrual would be your rate times enrollment or your budget in this case here. The accrual or the budget will be that green line. You can see we increased that in July of 2024 at the start of the policy period. And then in the blue box, I've just highlighted what your current policy period looks like so you can get a better snapshot of how that's running year to date. You can see in the beginning half of this policy year, the total cost was running below that accrual line, below that green line. As we are moving towards March, that cost is starting to creep above the accrual. So as I mentioned in this top right-hand corner, that is due to the seasonality that we see in a plan. So as we move through the end of a policy period, we do expect claim costs to rise. As members hit the deductibles, the plan will pick up more of that cost. So that's totally expected in our 12-month period. You can also see that taking place in the policy year quarters on the top graph. So if you look at July 2024, in the 3 years that we have showing here, that is the most favorable month. The second quarter is also favorable. And then once we get to the following 2 quarters of the policy year, that's where the claim costs really start to rise. We see the largest increase in that second half of the plan year.
What's the accrual number?
The accrual number, if we flip to page 6, and then on the right-hand side, the accrual rate cost for the total group is $1,273,000.
I just didn't know, like, you got all this in the PPMs. I didn't know if you had an accrual PPM.
It doesn't show it on this graph here, necessarily, but on give or take,
It's around 2030.
yeah, it's around 1,686 monthly. If we look at the aggregate in total.
So it's 1686 or 2031.
Total plan cost, the accrual on this report.
Oh, I'm sorry, I'm looking at the town.
So
Sorry, yep.
2031.
Roads. Okay. Okay.
It depends on the head.
Sorry, I was looking at it. It differs by head count, definitely, but the rate cost that we have here is stagnant based on the budget. We take the total budget and divide that by 12 to get the monthly amount, and then as the head count swings, that PEPM will change slightly. So if we flip to the next page, Janet asked that we spend a little bit of time looking at the seasonality a little bit more thoroughly. So I've included this graphic here that kind of shows how the seasonality factors affect the 12-month claims. You guys mostly have high deductible plans, so I would focus on that bottom half section of this graph here. As we can see in this example, we're seeing $12,000 in claims that we're showing over the 12-month period. So while each individual month of claims looks to rise through the 12 months, overall, we're still seeing, again, the 12,000. So instead of breaking that up $1,000 each month, the claim cost will rise as we get towards the end of the policy period.
Now, is this based on not our data?
This is just a graphic to help understand how those factors will impact, but not specific to Newington's data.
And it does, and it could be different policy periods too, right?
Either way, the 12-month period. So like in your case, this month 1 up top would be July, and
Yeah.
month 12 would be
Well,
June.
for somebody else, it may not be.
Right.
For another
right.
group, it could be January
be
through
Yeah,
December, correct?
So just like ours, I compared your factors versus what I did based on our 3-year averages, and it looks pretty close, other than March for us, which is 9th month is much higher than what you're showing here.
Right, and that could just be.
And that's, well, because, could be because teachers, before they go out for their summer vacation, have all their elective
Exactly.
surgery done, or everybody has their elective surgery done before. they go out
Exactly.
in the summer. So if this is a bunch of different fiscal years, it could be slightly different than our own data.
Right, there's definitely factors in the demographics that would adjust this. This is not specific to your
Yeah,
population,
yeah.
but just a general assessment of how these factors will impact the claims.
Yeah.
We would never add any of these factors to your claims, but this is just to kind of understand how month 1 we would expect claims to be 9.36%, and then in month 12, maybe 1.13% of your.
So we never,
average cost.
we never budget for the
We
seasonality.
don't include the any adjustments for seasonality in your data due to the fact
We do
that.
adjust for seasonality because we have a long period, so we're looking at 24 months of data. So that's all got the seasonality in it, then we give you a total claim pick at the end, which automatically adjusts for it because we're looking at the 12 months, we're projecting for the 12 month. So in
For the
this,
full 12.
for the
Yeah.
full 12 months.
Yeah.
So like in this example, we're saying you're having $12,000 of total claims.
Yeah.
And this is when they're gonna come in.
Right.
So we don't need to put an adjustment in to the calculation because it's already in the data.
24 months of 1,000 people is credible enough.
Yes,
Well, yeah, there's,
Of course.
we have a credibility adjustment that's separate from the seasonality adjustment.
I've answered both of your questions right now.
Mhm.
I
John,
guess
John,
so.
you
I'm just still. So are we gonna show numbers like this, or are we gonna just show $1,000 a month? For our budget?
That's not our numbers.
I know it's not our numbers, I'm just saying, it's very consistent with our numbers, though, because I've looked at our numbers over 3 years.
We would show $1,000 a month.
Okay. Just struggle, because then we don't really get a good feel for where we are, because we just say, oh, yeah, well, it's high, we're lower, we should have to be lower at the beginning because of high deductible.
in theory, I do agree with you there.
But we don't budget based on
Yes.
seasonality.
Okay.
On the annual total, our target is the annual total
Yeah,
amount
I
of the
know.
year. So that's what we're using for the budget accruals on the month-to-month basis, but I do agree with that logic 100%. If we're technically speaking, we could lower that budget in month 1 and increase it in month 12. But for purposes of keeping it consistent month to month, we're budgeting over 12 months.
Okay,
You guys pass an annual budget.
yeah,
So I guess the one thing we could do is in these meetings, provide you with the year-to-date seasonality adjustment. So you can see if we're running higher or lower in relation to norm.
Yeah,
We can do that.
yeah, no, I'd be okay with that. I just get concerned because we always say, just sort of hand wave and say, well, no, the claims are gonna be lower in the first 3 months and then higher then. So I'm just concerned of the message the town council may get. You know, oh, it's coming better, 400,000 better than planned at 6 months, but then the last 3 months we kill it. 300, you know, whatever, better than budget at the beginning. So I just sort of gives a false impression sometimes. So,
That's not the only thing in that budget money.
yeah.
Yeah.
Yeah,
There's a lot of different messages in there, and
Yeah.
I give them that message, it doesn't
okay,
come from this group.
Yeah.
If we're doing bad, I say, our claims are bad. This is what we're looking at,
okay.
yes.
Yeah, I just find it hard when we go through the year and have these meetings on a quarterly basis to really get a good feel for where we're at.
If it's helpful, I can start showing some of this data instead of a policy or date. I can also layer in the rolling 12, and that'll capture the end of the last year's, you know, higher costing these, like, you know, the months that are above 1.0. So we can kind
Yeah.
of show the end of the seasonality and compare it to
I
current.
guess just rather see the seasonal adjusted number.
Okay.
And compare against that, and on top of the budget, like you normally do, but just, you know, like show me what these, it depends on the rest of the group, I'm only one person.
I mean, I'm looking at page 5, and at the end of the day, the total group is running right around 100%, which I guess is the goal, right?
Right.
Okay,
Our goal is to run 100%. That way we're not leaving money on the table. We're not running over budget. So really, in a self-funded world, 100% is our perfect case scenario. And just jumping ahead to page 5 there and looking at that total group, we can see the net loss ratio is 99.9%.
but that's also now, and we've got 3 months left,
3 more months of data, correct?
And
which would go up, so that loss ratio is probably not gonna hold.
It's hard to say. I don't have a crystal.
Well, based
ball
on the
to look into
factors
it,
of
based on the
seasonality,
factors.
yeah.
Yeah.
And I guess the other question, I don't know if I've asked this before, and I probably have. Do the town and the Board of Education pay the same contribution rates?
You mean like the.
So I know the Board of Education has always talked about when they send their surplus back or whatever. I mean, if I was a BOE person, I'd probably be a little,
So we have a health benefit fund agreement with the Board of Ed.
mhm.
Should they come in under their claim amount, or should their claims come in under what the required contribution, they get that money back the next year.
So then
If the
this,
claims come in over, town absorbs it.
okay, so then this
So-
400K is not gonna be ultimately part of this calculation, so the deficit's more like 600 than 400.
Yeah,
Or
400,
than
yeah.
198.
So, and then when I look at the budget and do it, we want to have a certain amount of our claim reserve.
Okay,
It's a risk, and we are well over that still. We had good years before.
Okay.
The last one. Yeah,
am I making sense, John? Okay,
so what they will do is next year they will budget the full renewal because they don't know what this 400 will certainly go down. And this is both the active and retirees. So the deal we have with them is only on the actives, not on the retirees. So unless they split, so no one's saying that they get the full 400.
I think basically anything green here just doesn't even exist, so the deficit is more like 600 instead of 200 to the plan in itself. Okay, okay.
Okay. So jumping over to page 5 again, this is a summary of the next 2 pages that we'll be looking at the detail. But just to touch on the town, again, running the deficit position at $600,000. These are gross loss ratios for the town and the board. We do not have year-to-date PHI data to be able to split the large claimants out into the town and board buckets. So these are gross positions. Once we net out the net claims, both of these will improve slightly. So the gross position on the town is 122.7%. Again, that deficit position is about $600,000. This holds 27.5% of the population, so it's a much smaller bucket, much smaller amount of employees. So any impact of large claims will have a dramatic impact on the loss ratio, which is what's happening this year. Another piece that I think is very important to point out, and it's happening to both the town and the board, is we're seeing a large increase in the RX claim spend. So RX claims are making up 34.4% of the gross medical claims year to date. That is not too far out of range of what we expect, but it is an increase from the prior year. So previously in the prior policy, RX claims made up about 27% of your gross claim experience. So RX claims are on the rise. This is happening across the industry. We're seeing a lot of increase in pharmacy costs. Really
GLP-1s or?
really due to the GLP-1s. Yep.
You guys cover for weight loss?
Yes, we do.
And then the last point here in the town I'll make, and I already spoke on this, but the unfavorable cost is driven by an increase of severity and frequency of your large claims. So we can kind of get into that a little bit later. The Board of Ed is running in a surplus position. Again, the gross loss ratio here is 95.4%. This is a much larger bucket of the population. So 72.5% of the population is in the BOE group. Same story, as I said, our claims are making up 34% of the gross medical spend. And then previously that made up 25.8%. So we're also seeing a large increase there on the BOE side.
Is there a difference in the number of dependents per employee in BOE versus town, do you know?
Off the top of my head, I do not, but I
Okay.
can follow up with that information.
It's in here.
I was looking at that before. but
Yeah, because it
rabbit
shows
stuff, I
employees
didn't-
and total lives, right?
Oh, the info locker too.
I can see it.
No, it's not. That was the other page. It didn't make, it didn't make the cut.
Yeah, because I thought you had employees.
It's pretty close.
Yeah.
It's a 1/10% difference.
Oh, that's all, okay.
Yeah.
I just thought.
I just looked at it, yeah, I just looked at it
Yeah.
yesterday, it was like 1.4 and 1.5,
Okay,
something like that.
Yeah.
Like, I don't remember which one was which, but there wasn't a material difference.
Last thing we'll touch on this page, we already really spoke on the total group, but I will point out that there are 2 high claimants that have hit the 125 ISL at this point through March. So we've received about $206,000 in reimbursements. That is going to be split, some between the town and some between the board. Moving on to these subsequent pages, we have the monthly experience details. So we get a lot more into the nitty gritty of, the medical, drug, and dental claims, the different fixed fees that are included. And then the accrual costs, we can see the year-to-date variance and the actual loss ratios by month. So I'm not gonna spend a whole lot of time, walking through this. There's a lot of numbers on here, but I think this is really good information for you guys to take a look at if you want a little bit more of that detail. You guys have any questions on this? Do you want to pause and kind of look through some of these numbers? Now we can flip over to page 9. This is looking at our current year-to-date high-cost claimants. Again, this data is through March of 2025. So as we can see here, I'm tracking 17 claimants above half of the ISL threshold, above the 175, so 87,500. Large claims currently represent 20.2% of your gross medical spend year-to-date, which is actually favorable, I would say. A lot of my groups, large claims are really taking over a lot of the total cost. RX claims, though, if we look at these totals, medical claims are making up $991,000 of these large claimants. RX claims are making up $1.1 million. So again, RX claims are up significantly, and a lot of that is driven by these high claimant costs by the drugs that are taken for some of these diagnosis codes.
Predominantly the Crohn's disease.
What's the treatment for that? Is that Remicade?
Well, not too many
One of
cancer
them.
ones this time. I think in the past, we had some more cancer drug expenses, right? This time looks fairly low.
Right. Yeah, your highest costing diagnosis are not cancer this year. It's mostly heart disease and
Crohn's.
right, and we'll see that kind of followed in the block reports once we get to those pages. You also look at the relationships here. You can see the top 8 claimants are employee driven high claimants. We have a few spouses in here, but really a majority of these claims are driven by the employee. Any questions on your current experience? We're gonna flip to some stop loss renewals from here. Okay, so on page 11, we have current and historical stop loss renewal fees. I've layered in a few years, 5 years of historical data. We can show the initial increase versus the final, so you can see how we've worked to negotiate those savings. from what, they've initially pulled out versus what we've landed on, and then the year-over-year increase from there. So in a 2025, you're able to save 2.5% on your base ISL fee, and that's an 18% increase over your current cost. As you can see, for these 2023 benchmarks, we have the market average and the locked-in average for both. We were able to keep you still underneath this locked-in average and the market average as well. Anthem was not willing to, decrease our final ISL rate as much this year in terms of the fixed fee, but they were able to negotiate a $120,000 premium credit that will be applied to. It's a one-time fee that you guys will be able to apply to your premium. So if we flip to the next page, we can see how that will impact that 18% increase. So this is based on 637 members here. So we're taking that $152 fee and getting that to the annual total at the $987. I'm sorry, that's your current fee. So using the 129.21 times 637 times 12 to get the 987, hitting that with the 18% increase gets to the $1.1 million renewal for 2025-2026 plan year. That would be a gross increase annually of about $177,000. Like I said, Anthem is providing us a $120,000 premium credit, so we're able to offset a lot of that increased cost. Once we compare that new net increase to your current ISL premium, we're seeing this equate to about a 6% increase over current. Now, the rate will, of course, still be the 18% increase, but on your annual budget, we'll be able to see the 6% hitting the budget and the projections.
And there's no protections for 26, right?
We have the rate.
We
cap in
tried,
place.
we talked about stop loss, it's terrible. There's new things now, we even got stop loss quotes from everybody and nobody was close. We're still below manuals, and until we get to, that's why they gave us the 120,000.
Well, it keeps the rate at a level, which is
They
Good
wanted
for-
to increase the
right,
rates, but
right.
they gave us the money.
Mhm.
So hopefully we can do that again next year. We'll try, but there's just no room in stop loss numbers right now.
Now, is that because they're using more national data and giving less credibility to our own?
No, it's not you.
Well, I know.
No,
it's not you.
Well, I'm saying it's everyone. I've been blamed for a lot of things, not stop loss premium.
It's not new.
Yeah.
It's not specific.
Oh, no, Newington results are good, so I'm saying, I've looked at our prior stop loss payments that we've gotten, it's a lot under the million. You're gonna see a trend and stuff, and so I'm trying to say that they're not giving us credibility for our good results. And so everybody's getting a hit on the stop loss.
This is a pool, everybody's getting killed.
Yeah,
New drugs keep coming out that cost $1 million.
oh, yeah,
And if you don't get one, great. But if you have somebody that has one, then you blow up the premium right there.
Right.
So all of the stop loss carriers are doing the same thing, which
Yeah.
is getting everybody that they write cases with to the manual as much as possible.
Yeah.
So there's very little flexibility in the market. It's probably one of the first hard markets I've seen in 25 years in stop loss.
yeah,
Blue Cross also was losing money hand over fist when they were doing it in Connecticut. One of the reasons why we were seeing such low rates is we were able to negotiate really good stop loss numbers with the Connecticut team. The Connecticut team no longer prices stop loss. Anthem's brought everything into a central stop loss unit. Everything's being priced there, and that's the number. They gave us 2 points or 2.5 points off of that. That's the most they were willing to do. We got some extra money out of some other credits.
And there's definitely a value to having an integrated stop loss and medical coverage all in one place. It makes it a lot easier for reimbursements. You were mentioning the high cost drugs. Have you guys done any analysis of the population to see who might be at risk? Because you mentioned at 1 million, there's like Elevitis is like 3.2 for a treatment. So I don't know if you guys have looked at the diagnoses of the population. You guys have like a gene therapy risk report, because that could be, there's not much you can be able to do about it. And not everybody, like, for example, like sickle cell, not everybody who shows for that is going to be a candidate for the treatment, but it's just, it can sometimes be a little concerning?
We've looked at risk scores,
Mhm.
but not specific to that.
Because and new drugs are coming out all the time.
Right.
The pipeline is just growing and.
It's crazy. And there's a lot of risk in carve outs right now. The way Anthem and other carriers are paying pharmacy claims. We were talking about this the other day, is unless you have pre-authorization on your pharmacy, the pharmacy claim, which we have to get, this is future, but we have to get it. Unless you have pre-authorization on the pharmacy claim, what they're doing is it's a pharmacy audit trail. So they're not looking at whether or not it's medical necessity always applies, but they're not looking to see if it's a experimental treatment. So they
There's
can.
no step, nothing like that.
There's nothing in there if you don't have it in. So there's a risk there that wasn't there a year ago or 2 years ago. So while it was reasonable to try to get it into your contracts, and if they didn't want to do it, it wasn't a big deal. It's getting to be a big deal. So it should be a priority going forward, if you can get it. There's some serious risk there going forward.
So,
Not in stop loss though, as long as you cover it in.
right, just, well,
If you carve it out, then it becomes an even bigger issue.
I guess just mean even in general, and I don't know the contracts, but do they just pay a set percentage of whatever the contributions are? So it's not like if you're paying 250, then 280, then 300. It's not that. It's a percentage of the plan costs. So it almost makes sense for them to instill at least a prior auth in there, but that's not my place, but.
There's an argument, but it's definitely an argument.
Yeah, no prior auth, that's very 1990s.
Like I said, it's municipals.
Yeah.
And it's union contracts. And we've been successful in getting them in a lot of places, but not everywhere. And it's really a question of how hard we want to push.
You know what percentage of the plan they pay? Like 15 or?
Depends. PD pays a little bit more.
PD pays about 14 and a half,
Okay.
everyone else between 10 and 10.
And their new
It's fiscal
contracts
year.
bring them up in line with PD.
Okay. Should have been a cow.
Any more questions on stop loss?
Okay, so now we have a couple infolock reports. These are separate by town and Board of Ed. So these first two slides, the first two that we have are specific to the town. We have some key performance indicators. Here we can see the utilization by incurred claim basis. You can see how that has changed year over year. I actually want to back up 1 minute and say that our infolock reporting is incurred and paid data. So this data is incurred through December 2024, paid through February 25. So it doesn't align exactly with the data that I'm showing on the first two slides. And it is a rolling 12 period. So again, January 24 through December, and the prior period would be January 23 through December 2023. Again, pointing out the utilization by incurred claim basis, we can see some different categories here of utilization and how that has increased really across almost every category except for the last one, which is $0 claimants by allowed, which is actually favorable. We don't want your employees to have $0 claimants. You want them to be going to the doctor and getting their checkups. So that's actually an improvement. You can see then layered on to the right of that, the norm amount. So you can see how that compares to our norm or infolock norms. The other key pieces that I want to point out here are the top 5 conditions by prevalence. So we can see musculoskeletal is a really top one, really high costing compared to the prior year, but still slightly above the norm as well. Hypertension, hyperlipidemia, anxiety, and depression are also 5 key prevalent conditions in your data for the town.
But who's your book or the norm? Is that like all Anthem? Is that a municipal?
This is all of Lockton's book of business.
It's all of Lockton's book.
Countrywide.
Countrywide.
Sorry, ER visits are way up.
Yes, ER visits are up significantly. I would say that's a really big one. And then the other big one is the behavioral health is up drastically as well.
And let me just say thank you for like including this stuff.
Yeah.
This is insightful. Do you have any of the unit cost information?
By unit cost.
Like when people say, oh, is it people using the plan more, or is it the cost of the services that's driving it? Usually it's a bit of a mix of both.
I can look in, we have a lot of reports available, so I can look through and
This
see
is
it.
a snapshot of the
Yep.
Infolac report.
Yep.
And this wasn't an Infolac meeting, so if we're gonna do it, we can, I think we showed that a couple years ago. It's big. And it takes hours, or it could take hours to go through. We can have that full thing run and get it over to you guys and then set up a separate time if you
I
wanna
mean, this
go
is
through
good
it.
and it's a good snapshot. We don't detail, there's not a whole lot that we can do about it anyway, but just, it'd be interesting to see like where, because the utilization is off the charts. This is a high deductible plan, so it's weird that people are still using it like that they're not necessarily being stewards or using consumerism.
You talking about ER?
I'm talking about across the board. I mean, everything here is pretty much above your locked and book except for ER. And avoidable ER visits.
Well, admissions are, your admissions are up, but this is the town, and we know this year you're having a rough year.
Mhm.
So that's one of the reasons for your admissions going up. You were at 59, so you were better than the norm. This is a rough year to look at just that. Office visits are high, but and so are preventive visits, but that also points to your chronic condition impactability score, which is good. So what it basically means is people getting care that hopefully avoids larger cost items.
Right. I was also looking at the behavioral health too, which tends to be higher. I'm guessing it's a good benefit and there's no problem with that. I was just wondering what the unit costs for those categories are also doing to the overall cost.
Sure, we can get you the reports with I believe those are standard in the deck.
Yes, we can definitely look into that. All right, flipping to the next page, page 15, this is looking more detailed at the diagnostic categories. So we can again see, instead of the top 5, we can see the top 10 diagnosis categories, how that compares the high claimant cost compared to the non-high claimant cost. And we have a little bit more detail on some differences in the MPM cost by category in the subsequent right side chart. This one doesn't compare to our norms and it doesn't have that year-over-year experience, but it just gives the look into your current rolling 12. And again, a little bit more detail on the diagnosis categories, which we know high claimants are, always a factor to contribute to increased costs. So I just figured this was a good way to get a more detailed look at that data.
At least you must be a lot older, huh? In the risk score and the challenges.
It was in that other chart, we forgot.
Yeah. We have a couple.
We'll include a demographic.
Yeah, I did, yeah.
So flipping to pages 16 and 17, these are the same exact reports, but specific to the DOE, and they really have a lot of the same takeaways here. So again, a lot of our utilization is up in almost all these categories. We have a few exceptions, actually more exceptions here, but they are more so consistent with the year-over-year experience, which again plays into the BOE running more favorably this year. We can see on the BOE side, the admissions per 1,000 are better than norm under both years. We saw a large decrease there. However, there are a lot of increases. Actually, there's not.
No.
Decreases.
No, their ER is good. Their ER is good too.
Yeah.
The only ones that haven't increased really was the office visits per
Yeah, that's the only
1,000.
one.
They had a bad year last year.
Yeah.
You guys kind of flipped.
Yeah, it's our turn.
And
And a lot of these top 5 conditions are consistent with the town of Board of Ed. So again, the musculoskeletal, anxiety, depression, hyperlipidemia, and hypertension. Hyperlipidemia and hypertension did flip a little bit here compared to the town, but again, it was very consistent top 5 diagnosis categories. The last thing I do want to touch on, I know it is in the appendix, but there is a little bit more detail on the large claims in the appendix. This data is 1 month outdated from what we showed in the initial slide. So this is February through March data, but I was able to get the town and Board of Ed specific PHI data for, again, this rolling 12 period. So if you're interested in that, it is in the appendix. You can see on the town, we saw increases in the frequency, severity, and total cost at almost all thresholds, except for the lowest one, the 87,500. And then above the ISL, we did not see an increase in frequency, but we saw an increase in cost. And then on the Board of Ed side, we have the opposite story there. So improved data in the rolling 12 period compared to the prior. At almost every category in the frequency, and then in the severity trend, we saw a little bit of an increase at 150 and the higher levels, but again, we do have stop loss protection at 175, so that doesn't impact the net cost of the Board of Ed. Any further questions that I can kind of help understand this data, or I can take away and follow up with you guys?
So just for the follow-up, I have to provide John with a year-to-date seasonality adjustment through utilization versus cost as well, and then the demographics between the town and the board
Member employee ratio.
and member employee ratio.
Other than Dave said, we already saw them, so it's not that different, but
Yeah.
no, I've looked at that before. I just haven't looked at it recently. Thanks. I think this is a lot better than. prior
Happy to hear
presentations.
that.
Yeah, that
Yeah.
utilization information was very useful, help informative.
Yeah, even though, like you said, we can't do much about it.
Well,
Well,
they're
we
checking.
It's still good to.
Yeah.
The thing about the utilization stuff is that we do typically it's done once a year,
Yeah,
because it doesn't change that much.
right.
Really, on this small group, it doesn't change a lot.
Well, it changes a lot, but it's, the data usually, we normally do it once a year because, once again, is it actionable? Knowing about it, it's not unfortunately, due to the union contracts, almost none of it's actionable. It's, but what can we do about it without, it's, the best time to run it is right before union negotiations, so you have the data, so you know what to go after. And the big thing, and we've been talking about this a little while, was pre-authorization on the drugs and getting some kind of a programs in place from a wellness program standpoint for, say, mental health was a big thing we looked at. Bumping up the ability to do or encourage telemedicine on mental health treatment, or some kind of restrictions on where people go and things like that.
Guessing the MSK is also like mainly PT, OT as opposed to like surgeries, right?
I can look into that.
MSK could be knee surgery too.
Yeah, I'm guessing the volume of that is probably people going to.
Because they had the surgery, they're probably going to the PT.
That's probably number one in every single one of my.
Yep.
Yeah, none of this is really that surprising.
Other people.
It's musculoskeletal, it's cardiovascular, and it's and now in diabetes. And the diabetic drugs are driving up some of the drug costs. And next year it's gonna be worse.
The one thing I will say is different than our usual is there's not much cancer on your plan, which is
Yeah.
Which is a good thing.
positive. Yes.
I'll be quiet during the punching part, I promise.
What do you mean? You make me talk during the health part.
Thanks.
Well, thank you, everybody.
Thank you
Hey,
guys.
thanks so much.
Nice to see you.
Have a good night, guys. Thank you.
Hopefully the traffic's cleared.
Thank you.
Nice work, thanks.
Hanging in there.
I advise. Sorry, I'll go ahead. Stage? No.
Feeling freeze? Uh-oh.
Oh. Thank you guys for your confidence and continuing to walk.
Yeah.
Thanks for having you back. Well, we appreciate it. It's been a long relationship.
Yeah.
Well, appreciate that. We're still getting through this.
Yep.
See you later. Lou.
Okay.
Have a
Thank
good
you. In 3 months, 6 months, 4, 5, the next meeting.
We can talk.
Effective tariff rates back to the 20th century. Late 20s, early 30s, yeah.
Investment thing. Still trying to find. I am not a techie, sorry, guys.
No problem.
Sorry.
Hear us, David?
I can hear you.
See you very clearly, David.
It's almost as if I'm there. I'm sitting across the table from you guys.
And on both walls in the back too, so. That's surround David today.
I can't get the agenda up, so I'm just gonna stick.
We
with-
get talk. We can toss it through. Ready to start?
Yeah, whenever you're ready.
Okay.
Thank you. Guess we have a quorum, so that's good.
Yes.
The agenda, we're gonna go over a market overview, which probably have not much to say because not much is going on. We're gonna go over the pension, the OPEB allocation performance update. We were gonna go through alternative investment instruction, but we have 5 out of 10 of the board members, so save that for the next meeting. It's okay?
Yeah.
David, you want to kick it off and then please ask away because there's plenty to talk about in terms of the markets, okay?
Sure. And just a quick question, Janet. Is it easier if I share the screen if I'm able to?
Yeah, if you want to go through, I'd love to know, yeah.
Yeah, that's what I'm saying. Let me see if it allows.
The
let me see if it
handoff,
allows
David.
me to. Yeah, let me do the handoff. How'd that work?
Oh, there you go, yeah, you're there.
All
Got
right,
it?
there you go. You're off the hook.
Thank you.
You're welcome.
Yeah.
Okay, so I'll quickly kick it off. So the word of the year so far is uncertainty. We've been saying it a lot, but it really is relevant. You may have heard the expression, the markets don't like uncertainty. So bad news, good news, but when you don't know what to expect, you get a lot of reactions in the market. We use the word volatility, but it's wild swings, and those swings can be in both directions, which is what we've seen. I mean, we'll go through the numbers, but the portfolio is down very little for the calendar year so far, but that wasn't the case 3 weeks ago. And so just to, there's been moves in both directions, and it's really been around tariff policy or the uncertainty around tariff policy has been the main driver of the markets moving. So as of right now, our expectations, and this is just the base case, it does, there is a downside and an upside, but is that the effective tariff rate will begin to decline later, in this quarter, meaning there will be tariffs, but they won't be as high as what was announced a few weeks ago on Liberation Day. The economy will avoid a recession, but any delays to this clarity we're seeking increases the risk of a recession. All right, so that's sort of the environment we're dealing with. The longer the uncertainty goes, that's not a good thing for the economy. But we do expect the Fed to cut interest rates this year as well. So inflation is going to be, is a concern. So, but also economic growth and the impact of tariffs and all of this uncertainty is a secondary concern as well.
I spoke with one of our economists recently, just to get some insight as to the market reaction after Liberation Day. And his response was, every time you raise a tariff by 1%, you would expect about 0.1% decline in growth and a corresponding 0.1% increase of inflation. And so when Trump came out and started putting things like 46% tariffs on Vietnam, 20% on the European Union, 34% on China, you start to do the math and you're like, Houston, we have a problem here. This is not going to work. This is going to really harm the economy. And I think a lot of the reaction was due to that. Thankfully, Trump did back off of that. And, he pushed off a lot of these retaliatory tariffs 3 months. But we still don't have a tremendous amount of insight into what the future is going to look like. We've heard a lot about conversations having been had behind the scenes. So the hope is that there are some agreements that are going to be in place over the coming weeks and months. But the longer this delays, it's similar to driving in the fog. When you drive in the fog, what do? You slow down. That's what businesses are doing because they have to plan ahead and they can't see through the fog at the moment. So that comes back to the idea of uncertainty. The other big factor I would say is the market reacted very violently to the idea that Trump was going to fire the Federal Reserve Chairman. The idea of Fed independence is very important to the market. And so we saw a fairly significant reaction with some of the tweets. And then once he commented and said that he has no intention to fire, we saw the market rally back. So I think, as of now, it sounds like the worst of the tariffs hopefully can be avoided, but clearly we think that the longer this drags on, it's going to have a drag on the overall economy. Sorry, David.
So I will throw in the number from what Ashley said, tossed around, is we can withstand a 15% tariff across the board to the economy. Anything more than that is a big problem. Right now, it's a big problem.
What is the across the board? I mean, there's not, like, is there an averaged out number? I mean, no, it's all over the place.
We have 145 with China.
Yeah.
There's a pause for 90 days at 10% right now. Most of the other countries.
Oh, that's right.
You're saying more of a 15% tariff on average overall.
Overall.
Yeah.
So to throw in the unintended consequence, every time we come in, we've spoken about how the fixed income market predicts what's going to happen in the markets overall, because capital markets seem to know what's going to happen. We use two examples of what's going on in the real marketplace at this point. There's two different bond issues. One is Michael's Stores, which you guys probably know what that is. It's kind of the craft store that's around.
Right.
It was taken private by a private equity firm about 2 years ago. Their debt trades 100 cents on the dollar. That means it's a good bet. It was at 76 cents on the dollar about 4 or 5 months ago. It's at 36 cents a dollar today. That's because they get 100% of their product from China, and they've stopped all deliveries in place. They have like a 30 or 45-day inventory carry. They stopped all deliveries in China because if the deliveries were to come in, it was 145% more. They couldn't sell it. Okay, so their shelves will start going empty unless something changes in about 60 days. And the other one is Harbor Freight, if you know that company or not, but they make 100% knockoff Chinese tools. Okay, so if I'm a contractor, I'm just starting my business or homeowner, I can't afford the better product like a DeWalt or something like that, I go to Harbor Freight. They've stopped all shipments in place also because they bring in everything from China. It's going to be 145% more. Their consumers won't buy them. And you take that to every other industry, and that's going to possibly happen. And shelves will start showing a lot less inventory on the shelves, okay, which will slow down the economy. So that's stuff that has to be brought to light, and people have to start realizing that's what's going to start happening.
It's just at Harbor Freight this morning, and they're pretty well stocked right now.
Right
so.
now, they're fully stocked. We know for a fact they stopped their stock
Yeah,
of ship.
yeah.
So as far as with the 3-month hold, my guess is going to be another 3-month kick the can down the road, or do you think there'll actually be something? I mean, I know they're saying that they're negotiating this early, and I thought I heard somebody say they reached a deal with India, but I haven't seen anything beyond that.
They're close.
They're
There was
close.
one-
And I don't even know, I mean, China and them are probably talking, but
Yeah.
it doesn't seem like China's like just middle finger and back saying, okay.
Well, when do shock and awe at this level, you're gonna back people into a corner, they're gonna come out like animals that are injured, okay? The other thing to keep in mind, and we look at a different scenario that's a little bigger, is why is this being done? Okay, so the two things are, one is Bessent, who's the Secretary of Treasury. At this point, people don't remember, but in 1991, he was with a hedge fund run by George Soros, and before that, he was with a couple other hedge funds. But he's the one that broke the English bank, Sterling, in 1991. So he's the first person that ever put on a position slowly against the British government and broke the sterling and made $1 billion in one day on that bet, followed by a second day of $1 billion. So part of the discussion here is Bessent being appointed as Secretary of Treasury, which his politics are direct opposite of Trump's and the current administration. Did he have a vision with Navarro and Lutnick of breaking the Chinese economy? But there's a lot more pain, because if you think back when this first started, Bessent was trying to get Trump to go 10% a month and put pressure on, but we got shock and awe instead. So it's a dislocation. So the game might have been a little bit different had it rolled out the way we believe that Bessent was supposed to put it. Okay? So it's a different point of view as to why this was, and it had to be done from the other standpoint. And we go off a little bit here, but if we're to go to war with China right now, okay, and we lost 30% of our Navy in the first 3 months, and they lost 30% of their Navy, it's who can replace the ships the quickest, right? We don't have a lot of origination of steel in this company. A lot of the stuff comes from offshore. The real ratio is, remember I said 30% on both sides. China can, if we lose one ship and they lose one ship, it takes us, what time it takes us to make one ship, it takes them, they can make 260 ships at the same time. So their supply chain is really stronger. We let that kind of happen. Politics aside, in terms of safety of the country, that's at risk also at this point. Okay.
Well, the international trade is kind of what's kept a lot of the peace.
Correct. Kind of went the other direction.
Yeah.
Yeah. Okay. David? Go through a couple other pages.
Yeah, so everything that we've kind of been working through in the past month is about, adjusting expectations, but the reality is we have not yet seen a downturn in the economic activity or in the actual data. And so that could come but it depends on how quickly that the clarity comes to businesses, et cetera. So we haven't seen a downturn yet, but we have seen a downturn in sentiment, or basically how both individuals and businesses feel. So you see on the left-hand side, I mean, you really just got to focus on the right-hand side of each of these charts, and there's a dip in business sentiment, and then there's also a dip in consumer sentiment. So that's why we keep saying the longer this persists, the higher risk that the economy will take a hit. There's a third layer of sentiment that's related to the portfolio, and when you're making portfolio decisions, and that's how investors feel.
Can you pull out the pages because everybody's not facing the screen? So.
Oh, sorry. So I'm on. I was just referencing page 7 with the business and consumer surveys, and page 8 is an investor survey. So, which measures what percentage of investors are positive on the stock market going forward, and right now the reading is at 25%. Or about 25%. The long-term data shows that in the future, anytime that this rating dips down below, it's actually positive over the next 3, 6, 9, 12 months. Those are the blue bars. So again, it's just statistics, but when you look back, usually sentiment is a contrarian indicator. So that's not to say that if we actually do go into recession that the markets don't have downside, but in general, this is just another piece of data to use to not make drastic decisions when you're dealing with long-term portfolios.
A lot of what's going on now is a self-fulfilling prophecy. Everybody's reading the press, seeing the news, so everybody's pulling back, and it's causing the sentiment in a lot of ways to go down. We'll use the Magnificent Seven that we talked about before the tariffs started. So if you guys anybody here ever saw the Magnificent Seven movies, either one of them, only 3 survived, okay? So far in the earnings, you had Meta and Microsoft. So those are 2 survivors. Today we had Amazon and we had Apple. They kind of took it on the chin today, not in a big way. So that's 2 out of the 7 so far. So if movies predict anything, we'll have 3 of the Magnificent Seven still doing well this year. Okay.
That's funny too, the sentiment's so weird. One of my buddies talked to him earlier this week and it's like, oh, I'm down so much. It's like, dude, what have you done in a 1-year period? Oh, I'm up 8.5%. It's like, what's the problem? Well, I was up 25 3 weeks ago. It's like, yeah, so you're still up 8% for the year.
It's sentiment can move fairly quickly.
Yeah.
From one extreme to the next.
Yeah.
And we've seen that recently.
Just with the graph, just how irrelevant it is. That's, I'd never heard that before.
Yeah, it's something of a contrary indicator. You know, most of the time it doesn't have much of an impact, but when we see the extremes, either, you know, everybody thinks the stock market's going to continue to go up, or nobody wants to touch the stock market because they're so afraid. Usually the market historically has acted opposite of that. So, you know, when we see it as depressed as it was, historically the follow-up returns have been pretty strong. And this report was run as of April 17th. So we've only had a few weeks since that time, and we've had a pretty good rally in the market following that.
Page 12 we're gonna go to, David, is that right?
Sorry, I was muted. What'd you ask, Mark?
Page 12?
Yeah, page 12, just to kind of show, while, so there's, as usual, we always put things in ranges because, you know, it helps to create a framework in decision making. And right now, if you focus in the middle, our central scenario, and which is also what we think is most likely to happen right now, is that, you know, by the end of the year, in the second quarter that we're in it, but also the third quarter, the economy could slow down. But starting in the second half of the year, we should start to see the Fed cutting interest rates, and ultimately, if we avoid a recession, or even if the recession is a mild one, you know, there will be a recovery going into next year. That's the central scenario, and again, supported by lower interest rates. You know, the upside is driven by sort of quick resolution on lower tariffs, but also a refocusing on AI and earnings. And we're going through earnings season right now, and we've had a couple of those, you know, big leaders in the space, US tech companies, have some pretty positive results there. So, and then the downside is again, you know, more of that recessionary outcome. And if you want to translate those on page 13 into US stock market predictions. So right now the S&P is kind of a, you know, a little bit below these numbers. So you can just estimate that central scenario by the end of the year up another 5% or so from where we are. So, you know, we're not calling this calendar year to be a repeat of the past 2 where we had double-digit stock market returns. You know, but you can take a look at that downside scenario, you know, and evaluate. Now that's from where we are today, and the S&P is really only down 4%, with the recent rally for the year so far. So that would be, you know, things get worse again, and we go back down and test the lows that happened not long ago.
Questions on the markets, or? Okay, one thing we failed to say during the agenda, David, Ashley, is we have new capital markets assumptions, which drives the asset allocation. We're unique at UBS. A few years ago, we decided to have 2 different asset allocations. One's called strategic, which is a 3 to 5 year look or a business cycle. And there's also an equilibrium, which it's a way an actuary will look at it. We changed our capital markets assumptions about 2 months ago. So the next meeting we'll come in with a new asset allocation to review. Okay. Before we go through the returns, as David said, John kind of pointed out, everybody from looking at the press expects the portfolios to be down 20 to 30%. It's something really terrible, but go through the numbers, we didn't have those kind of returns at any point. The diversification of the portfolio was held up really well. David, you want to start and actually jump in?
Sure. The starting with the police pension, page 15 is the portfolio's valued at 67.6 million and has an allocation of about 62% in stocks, the rest in stock and bonds and cash. Following page, so when we ran this was as of you know, a week ago. So the calendar year, the portfolio was down 3.32. We ran it as of yesterday, and it's down less than 0.5%. So it basically rallied 3% in a few days. Your fiscal year return, and all the pensions are going to be similar, is about 4.5% through yesterday, positive.
Yeah, and just so you know, so we're reviewing the police pension plan. We also have the municipal pension plan and the admin pension plan and the OPEB. Effectively, all of these plans are invested exactly the same. David, I believe we hold a little bit more in fixed income in the OPEB plan to cover regular distributions, but the 3 pension plans are invested exactly the same. Is that correct?
That's right. So yeah, so right now the portfolio, this is a view of where the allocation is on a high level versus the longer term target. So there's a slight overweight to equities, and the international allocation is right in line with the target, which you'll see in a second helped the overall performance. Actually, if we go to page 19. This is through the end of the quarter. So the first 3 months of the year weren't too bad, down 0.43%. It was really April that was the down and the back up. And so the trailing 1 year at 5.7%. Now, this is the first. So for a long time we were relying on the U.S. stock market to drive returns, and if you just focus on the 3-month column, what you'll find is that the S&P was down 4.5%, but it was also a tale of 2 types of stocks. So basically, the growth stocks, which led the way over the past few years, they were down more than value. Value was actually a positive. In this case, your manager was up almost 4% in the first quarter. Next, Kane Anderson in the middle of the page. Small cap manager down, but down less, basically half of what the benchmark was in the first 3 months. So good protecting, relatively speaking, on the downside. And then finally, we have that international piece that was up, 8.5% and 5.5% respectively, with the 2 international components. So it's nice to see that the idea of staying diversified and having some international exposure helped smooth the ride in the first part of this year, because the U.S. has outperformed international markets for several years now. But the reason you keep that is that eventually things turn, and it just makes the overall experience an easier one, because the portfolio doesn't go down as much when certain parts act differently. And then finally, in a similar way, the bond portion of the portfolio is all positive for the year, and we expect that to continue, especially if interest rates come down. We'll see, the income will continue to accrue in these portfolios, which is all above 4%. Plus, if interest rates come down, you may see some price appreciation of the underlying bonds as well.
Now, are international equities hedged, or are we getting some benefit from the dollar weakening?
They're all
You guys-
unhedged.
They're all unhedged?
You receive some benefit, yeah.
Okay,
So there were 2 factors that really drove performance in the international markets. As you noted, the dollar has weakened against fairly significantly this year. relative to a number of.
No, it's just in Europe.
But what also happened is if you look at the US stock market, particularly the US large cap market, we have many more technology stocks as a percentage of that index versus the international markets. And technology really was the area that was hit the hardest. So the indexes actually did okay in the international world. So you got the dual boost from the index construction as well as the currency weakening in the US.
Any questions on portfolio or performance?
I'm gonna point two things out on this page, David. So when you look at the total and since inception date, it shows 7/31/2000. We were not on the portfolio starting at that point. We started about 8 years later, 6 years later, actually. And we reconstructed it back to that time period. The town actually owns all this data. It's on a system called Informa. In the next 2 quarters, we're gonna be switching over to Clearwater, which is much more robust reporting, with more risk management tools that we can report on. We're gonna run it side by side. Again, the town will own all the data with that. But we reconstructed it originally back to 2000 with the records that we did. Okay.
So as Ashley mentioned, the other pensions are similar, but we'll give you a high level view of the allocation and the performance. So here's the municipal pension,
We go to
almost
page-
32 million. Page 24. Sorry.
The cash at the top, just to report on the growth over time. Page 21 at the top. Do that real quickly. It's for the record.
So this page shows not only the returns calendar year by year, but also the dollar changes, the money that went in, as well as the money that was earned. So, if you take a look, for instance, 5 years ago, the pension had 46 million in it, and a net withdrawal to pay benefits was about 4.6 million, and over that time, the pension grew 27 million. And so that's just further data to show the historic growth of the portfolio.
Page 24.
Allocation similar. This is for the municipal pension, about 32 million total. And as we just go to the bottom line on page 28, as mentioned, you'll see a very similar portfolio. The administrative pension, that's page 33. So this one has allocation is slightly different. As when we ran this report, there was a little bit more cash available. That's because it was right before pension benefit payments were distributed.
David, do you guys move cash over every month for the monthly benefits, or?
We do.
Okay. So you take it out of bonds or wherever to?
Yeah, we take it proportionately. In fact, if you look at the page 37.
Yeah.
And you focus on the net cash flow column, you can see it's coming from both the stock and the bond side.
Yep.
So over time, it's a way to quasi rebalance. You're taking a look at where your targets are versus where your actual allocations are.
So do you try to maintain that balance when you're doing the monthly cash flows?
We generally do, yes.
Okay.
There are times though where we maintain a slight tactical deviation from the targets.
Yeah.
So that's by design, but you know, we do, the decision on where to take it is dependent on if we think we should cut back or, you know, maintain certain allocations.
Yeah, and when there starts to be a little bit more drift across the different pensions, we'll discuss with Janet just a rebalance and the natural time to do that at least once a year is when the annual contributions come in, right after in the beginning of the fiscal year.
Yep.
So that's usually definitely one time where everything will get trued up. And then the final portfolio is the OPEB, page 42. So here you see it's a slightly more conservative portfolio, 55% in equity versus the 60 plus in the pensions. Now, that just happens to be where the allocation is today. By the next quarter, what will end up happening is that there'll likely be another distribution to pay claims. We take that exclusively from the fixed income side. So basically, the way this has been working in recent years is the annual contribution comes into the OPEB in July or early August. That 100% of that goes into fixed income, the more conservative portion of the fixed income portfolio. And then at each quarter, as distributions are needed, it's taken from the fixed income. And whatever's left over is in the portfolio for long-term growth. And it's a strategy that's worked nicely, because what we want to avoid is investing in the stocks market and then having to sell at lower inopportune times. So really, the idea here is that the stock allocation never needs to be touched. But the underlying components are all the same. The underlying, investment managers are the same. It's just the allocations are slightly different.
You said any changes for recommendations, that's gonna be next time.
Feel about what tariffs and taxes are gonna do, huh?
The news
I'm
cycle,
not putting any money on that, but okay.
the news cycle's a dog year, so.
Yeah.
If there's inflationary pressures or real inflation, like you were saying, like shelves started to get seem a little bit empty or something, how are you gonna reduce rates?
It's tough because the Fed does have the dual mandate, right? Where they want to maintain price stability and maintain a strong economy and a strong job market. And, it is possible if the tariffs stay in place for an extended period that the Fed has to be at odds with each other, but they can't do both. They have to pick and choose. So it'll be interesting. The market right now is pricing in a number of rate cuts between now and year end, despite the expectation that inflation is going to rise, because the expectation is that the labor market's going to loosen, it's going to weaken, and that would give the Fed the cover they feel they need despite higher than average inflation. Jobs numbers, jobless claims came out today, and they were much higher than anticipated. Now, granted, it's only one data point, but jobless claims come out every week, and they tend to be a leading indicator, so the market pays attention. So I think the market's going to start building this idea of what the heck is happening to the labor market, and if it continues to weaken, it is possible that the Fed, despite having above average inflation, will start to lower rates. That's been a big holdup of theirs, is that the job market for a while now has been very, very tight.
Right. So the opposite argument to that, investment right now is making the argument that rates should be cut, because one of the things that's happening is the 2-year treasury is paying less than the Fed funds rate, which is what money markets essentially pay. So it's supposed to be the other way around. If you have a 2-year risk on your books, you're supposed to get paid more if you have a 1-day risk. It's upside down right now. So that's the argument to bring rates down. The opposite, what Ashley just said with unemployment, JP Morgan's economist who I talked to the other day indicated that if you take really a look at the unemployment, the immigration that's going on right now, we have a negative immigration rate, is that the unemployment that's going to occur is going to be eaten up in the workforce. Deregulation goes through by the end of the third quarter. Because normally we need immigration coming in to meet parts of the workforce. So that workforce may actually shrink while we're losing jobs at the same time. People have to take other jobs. Now, because what you just said, if we have inflation and the job market is actually not weakening because of lack of immigration, then rates would have to move up. All this is, we'll see what happens.
In a normal world.
In a normal world, yeah.
Well, what's gonna happen if foreign countries won't buy our bonds anymore? We're gonna have to raise interest rates on the longer term stuff.
Obviously, yes.
That's never happened, has it?
Well, actually, Japan is the biggest buyer right now. China has been buying less and less bonds. I think they're down to 14 or 15%, where they were probably 30%. So what's happening in the bond market, and this is going to be a little esoteric, so ask me questions, but if you remember in the 1980s, 1990s, Japan's interest rates were really high and ours were low. There was something called the JGB trade. So JGBs are Japanese treasuries. So what hedge funds and banks were doing in the United States and in Europe is you could borrow money at 3 or 4% in the United States, okay? Go and buy the JGB bonds, which were at 9%. So you have a 6% spread right away. You borrow the money, make it 10 or 30 times more. And what you did was then hedge the currency out, and you could clear 2 or 3% very cleanly with a minimum risk, okay, other than the currency hedge. Think about the fact that here our rates are at 5%. I could go into Germany, I could go into China, I could go in parts of Europe and borrow the money at 0.5%. Okay, a bank or a hedge fund, I borrow the money in Europe at 0.5%. I invest in 5% bonds here. I don't have to necessarily hedge it if I can borrow in US currency in the European banks. So you have a US Treasury trade going on that's similar. So a lot of the money that you see going into treasuries right now, in our opinion, this is within our own group, there's a lot of hedge funds and banks that are buying US treasuries and borrowing money in other countries. So your question is, that could evaporate real quickly if our rates get too low relative to the other currencies. Okay, these are thinking the unthinkable at this point. There's a lot of movement going on now. I've been doing this for a few decades and there's never been so many moving parts.
Wow.
Okay.
Yeah, I mean, the other thing to consider, we've been effectively exporting dollars overseas because we import a heck of a lot more than we export. So that means we're sending dollars to all these countries, which they have been in turn investing in our real estate, in our public equities, in our fixed income. And if the tariffs do what you would hope they do or what's expected of them, and that trade deficit starts to contract, it could be that they just have less buying power for our assets. So something to consider as well. But there's definitely a shift happening. There's no question there is. And I think there's still a demand for our treasuries because we're still the most liquid market in the world. But there is a sense that I think there's going to be trade, not just with the US. I think, post World War II, everything was pretty much done in the dollar. That was the agreement that was struck. Now we're starting to see other countries create their own agreements. So what impact that has on the dollar going forward is hard to say, but probably going to slowly have alternatives.
You mean like moving towards the won, or are you talking like multiple currencies?
Multiple currencies. There's no, right now, we're still the reserve currency, so I don't think that's going away anytime soon. But, I do think that the dollar's, strength abroad is going to slowly dissipate.
David, you got good news?
I like our health stuff better, and that wasn't that great.
You have more control over that.
Well, not necessarily, right?
GLPs now, but
Yeah. Cancer drugs, a lot of it.
Well, it's not going to happen tomorrow, and that's why you stay diversified. You own things like real assets and things that benefit as the dollar weakens. And I'm not suggesting the dollar is going to collapse by any means, but I think there's a good argument to be made that you want to definitely be diversified and not have everything in US dollars.
we had certainty, I think the market would still be doing really well. The economy's still doing well. It's the sentiment that's really poor right now. You can adjust to a weaker dollar. We've done it before. It's like 1970s. This is not new. Just the
We had
uncertainty.
pretty high interest rates at the end of the 1970s, so.
I can say
Yeah,
my-
room to play.
my first mortgage was 11 and 7/8 floating.
Yeah.
The boss told me he won a lottery or something like that. This was a long time ago for 18%. It was like early 80s, I think.
Yeah, like 80, 81, 82.
Yeah.
something,
Yeah.
84 through 84 actually.
Yeah. You get tax-free munis for 12.5% then.
So my market was paying 9 to 11%. Got a CD, got to choose a toaster or a set of glasses. I'm sure everybody's parents did that at some point.
They sure did.
And there were 3,000 savings and loans banks, and there's not a single one. So we've been through cycles like this before. Okay. Any questions or?
Hope to see you in 3 months.
Yeah.
On the email. Get an idea what I thought about.
That was insightful. Actually, it's the real reason why I come here.
Otherwise, you're gonna quit the committee, huh?
No. Thank you.
Okay, thanks. Safe travels back.
Enjoy the summer.
Thank you. You did. Ended up one catch-up document. And, sign. This is
Thanks,
stating
David.
that we have no bond proceeds.
Okay, thanks, everyone.
Thanks.
Talk in a few months.
Right here.
Right.
I didn't really mean that about that too. The reason why I came here.
Thanks.
Happy we haven't used the capital markets or something.
Thanks.
If there's anything urgent, we'll call special meeting with Janet.
Yeah.
Thank you. Just looking at those things, administration.
Sorry.
I don't think that's right. It's showing a positive cash flow and contributions are 800,000. Outflows 1,000,001.
You're correct.
Yeah, it looked like it worked all right in exhibit 6. It looked like, so I don't think the answer was, it looked like somebody just subtracted those instead of added them.
Yeah.
So on this one, they just added across.
Okay. Thanks for that feedback.
You want to introduce yourself?
Yes, I'm new here, so.
Yeah, let them know what's going on.
Yeah, so you guys are, I'm sure I've been used to Becky Selman for many years. Becky will be retiring over in the next
What?
year. Not till next March, but I've been behind the scenes kind of all around. I'll be taking over for her. Forward. I've been with Melanie for 13 years. I'm a principal as well. So.
So you're getting her whole municipal book from her?
Yeah, for the most
Yeah.
part, yes. So, pleasure to meet you all.
Tell Becky I said congratulations.
I will. And so I'm here today. She had a prior engagement. She would have been here today otherwise, but she had a prior engagement. So we figured it's a good opportunity for me to come and meet the committee and get to know everybody.
Okay.
Pull up your thing in a second.
Sorry, Jane. She didn't see the head. Thank you.
There, it's scribble, but it's there.
You had a great summer.
You too.
Everybody.
Which one do you want to start with?
It doesn't matter. I have the police on the top of my
Please.
pile, so we can do that one first.
This is always our favorite.
Ready to get started or?
Yeah.
Okay. So so I have 3 presentations here today. They're all very similar, some slight nuances on the liability sides. General takeaway for all 3 plans is, fiscal year 24 was a good year, as we all know. Funded ratios remained fairly flat from last year to this year. I'll get into why in just a minute. And generally speaking, while contributions have gone up from last fiscal year to this fiscal year, that for 2 of the 3 plans have gone up by less than we expected. So that's good news. Okay, I'll get into more of the details there. So starting with the police pension plan, moving up to page 1. We have This slide goes over the membership in the plan. We have a snapshot as of July 1st, 2024, as well as some historical information. During the year, we had 3 members terminate that were not vested, and they were just received a refund of contributions. 1 member entered the drop. 2 people retired, and there was 1 retiree death. Okay. Active populations remain static. This is an open plan, so as people terminate employment and retire, they're being replaced by new hires. The bottom left-hand side of this page shows the distribution of your active membership based on agents in years of service. You can see there's a very high concentration towards the younger, shorter service people. Very young population as far as this plan is concerned, much longer duration, so it can absorb changes better because there's a longer time to make up for any adverse experience.
So active members just means participating in the plan. It
Yes,
doesn't
so,
mean,
yeah, I'm gonna take a step back. Active members are those who are actively employed and in the plan
They're still contributing.
and contributing.
and what's members in pay
Members in
status?
pay status are those collecting a check every month.
Retired.
Oh, okay, so so that is totally, I thought pay status.
Payroll status, it's
Yeah,
paid from the pension.
Okay.
and then your terminated members, there's only a handful of those. Those are people who have terminated employment but have not yet eligible to receive a benefit. They will at some point in time. And then we have the members in the drop. Those are the people they're still actively employed. They've entered the drop, and they will come out of that drop and start collecting a benefit at some point in time.
They do continue to contribute. So they're actively working, contributing, but they get their pension payment put over into.
A different account. Moving on to page 2. Page 2 gets into the assets. And as was mentioned earlier, all 3 plans are invested very similarly, so the results here are very similar. Just the numbers will change, but the returns, you can see it's been a roller coaster ride over the last 5 years. You know, fiscal year 21 was great, followed by a really tough fiscal year 22. The last 2 years have been really strong. Current fiscal year, we got a few months left. Sounds like you're just below the target of 6% right now. Who knows what the next couple of months will bring? Who knows where we'll land at June 30th? Looking at July 1st, 2024, we can look at the actual value of assets and the market value of assets. So as you know, the actuarial value of assets smooths investment gains and losses over a 5-year period. Okay, so if you go back to this graph up top, that large gain in fiscal year 21, it's 80% recognized as of July 1st, 2024. So next year we'll have 1 more year, it'll be fully recognized. The loss in 22 is 60% recognized. We have 2 more years of recognizing that loss. That will continue to put downward pressure on the funded status of the plan, but it is being partially offset by the 2 gains in the last 2 years. What happens this year will help to kind of mitigate that. As of July 1st, 2024, the deferred gains and losses are pretty much equal to each other and they're offsetting.
Yeah.
So the market value of assets and the actual value of assets are essentially the same. So that's where we're at this point in time. Moving on to page 3, this is an analysis we do every year as part of our valuation process. We take the target asset allocation and we apply it against Milliman's capital market assumptions. Now, they're not exactly the same as UBS's, but not materially different. These are based on our financial experts. We use our capital market assumptions as of June 30th, 2024. The top graph represents your asset allocation. Each bubble represents an asset class that you're invested in. The larger the bubble, the higher the allocation to that particular asset class. The further to the left, the less risky it is. The further up in the graph, the higher the expected returns. Those to the bottom left of the graph are low risk, low return, countered by those tending towards the top right of the graph, higher risk, higher return. The black dot kind of in the middle represents your entire diversified portfolio. On the bottom part of this page, we have we take these asset allocations, apply them to our capital market assumption, and calculate expected long-term rates of return over different periods of time. Because this is a pension plan and a long-term obligation, we tend to look at the 30-year horizon because this is what we're talking about many, many years down the road. And over time, in shorter years, you'll see there's a much larger range of possibilities due to the volatility of the portfolio. Over time, the way the math works is the returns tend to converge towards what we call the median, the 50th percentile. And for this portfolio, based on our current market assumptions, the return is 6.8%. Now you're currently using a 6.125% rate of return for calculating the liability. Using this analysis last year, the return was expected to be 6.6%. So it's slightly up from last year due to capital market expectations. We know this is volatile, uncertain times. So while there's a gap between our expectation of long-term rate of return and where we're valuing the liability, we don't recommend making any changes to that at this point in time. You're at a nice conservative place. You've worked hard to get the interest rate down to 6.125%. I wouldn't want to recommend increasing it just for things to return back to where we were a few years ago and have to work hard again.
Do you have a feel for how our 6.125 compares against your book of business, so all municipalities?
It's probably a little bit more conservative
Okay.
than some, not all. I have some in the 5%
Okay.
range, 5.75% range, a lot, 6. But you're probably, the average is probably closer to 6.25, so you're not that
Okay,
far
yeah,
off. So you're right about average, I'd say.
Do you do Bristol? Cause
We do.
they have a lot of, don't they have like private equity?
Yeah,
and
they have,
everything in there? So
they have a fairly risky
Yeah,
portfolio.
yeah,
They're also an overfunded plan, so they
Yeah,
can take on a
yeah,
little bit more
right.
risk.
They're overfunded.
They haven't made a
Oh, yeah.
they've made a contribution in about 20 years.
40 or something?
Yeah, they're down to like,
It's called the SBN. Well, extra money they get from property tax and the
they're
SBN.
down
they
to
put
about
in there.
115%
Oh,
this year,
okay.
but
Yeah.
they haven't made a contribution to their pension plan in almost 20 years. Probably the only town in the entire state, but that's in that position. But yeah. Okay, so moving on to page 4, we can look at the liabilities. So on the top left-hand part of the page shows the growth in the accrued liability over the last 5 years. It did increase from $91.9 million last year to 93.7. We expected it to increase to $93.2 million. So it's about $500,000 loss there, mainly due to more retirements than expected, especially from one person who purchased service in order to meet eligibility requirements. So we weren't expecting them to be eligible to retire, but then purchase service and hit that. And it is an option in the plan, and,
Yeah.
and it did drive the liability up a bit. The losses were partially offset by some gains due to turnover. I mentioned 3 people terminated without a vested benefit earlier, as well as a COLA that was a slightly lower than expected. The cost of living adjustment was just over 1.1% versus a 1.5% assumption. So a little bit of gain there. When we compare the accrued liability to the assets, we come up with what is known as the unfunded accrued liability. That difference is the unfunded accrued liability. And that grew from 26.1 million to 27.0 million. So, and that's exactly what we expected it to get to. So although there were liability losses, there were some gains on the assets that kind of offset each other and landed us to where we expected to be on an unfunded accrued liability basis. Looking to the funded ratio, it did decrease slightly by 0.5%, and that's just due to the liability grew, the assets grew more than we expected, but the ratio still it dropped a bit, but fairly steady.
And I think part of the draft plan just came in.
Okay, yeah.
Yeah.
So, you can see there's been a decline in the funded ratio over the last several years. Part of that is due to the market. Fiscal year 22, you can see that large drop from 78.2% to 73.8%. That was mostly due to the market. We did decrease the discount rate a little bit that year as well, so that also increased the liability, decreased the funded ratio. And we've continued to decrease because we've been still recognizing those gains in the actual value of assets, and that's just the way the mechanism is. But it does smooth things out as far as the budget's concerned. And moving on to page 5. Take the assets, liabilities, put them together, and that's how we come up to calculate the actual determined contribution for the year. As a refresher, the actually determined contribution has 3 main components to it. The first being what we call the normal cost, and that is on the top graph, that's the darker green section of the bars. The normal cost represents the present value of benefits expected to be earned by active employees over the course of the next year. That went down a bit compared to last year. It actually went down by more than we expected it to. We expected to be around $737,000. It's just about $700,000.
Vacancies.
Yeah.
A lot.
Yeah. Yes, that is why. The second component is the past service cost. That is the amortization of the unfunded accrued liability, and we're down to 11-year amortization period this year. Next year we'll hit 10. Once we get 10, we might start talking about changing that amortization policy because we don't want that amortization to get too short. Because if it does get really short and there is something that adverse that happens in any given year, you have a very short time to amortize it over, and that's going to add a lot of volatility and fluctuation to the contribution. So we'll talk about that probably next year a little bit more or the year after. But we are getting to a shorter period, and we'll think about that. Most likely we'll think about doing a layered based amortization. What that means, if you want to equate it to something that you might be more familiar with, is think about if you have a mortgage on your house, you take out an equity line of credit to add an addition 1 year, and the next year I want to add a new deck. I'm gonna take out another equity line of credit for that component. So just amortizing any additional gains and losses each year and letting the original basis kind of run out. So it helps to smooth things out over time. So it's something we may think about doing, but we're not there yet. Just some foresight there. So the past service cost is 2.8 million. We expected it to be 2.9 again. It was a little bit lower than we expected it to be. So therefore, the contribution, while it went up from 3.45 million to 3.7 million, we expected it to be almost 3.9 million. So there is some good news there. Part of that is due to the investment returns. Part of that is due to the town making an extra $100,000 contribution above and beyond last year's ADC. So that all helped to bring down the contribution relative to our expectation this year.
Now, if we were fully funded,
Mhm.
our contribution would be about 700,000 plus interest. whatever it
Correct,
was.
correct. And if you are more than fully funded, you could use some of that surplus
Right,
to
to
offset the normal
cost.
Correct. And that's why Bristol has no contribution.
Yeah,
If
yeah, I just had one of the councils ask me, why would I want to be fully funded?
All right.
It's a good thing.
Page 6.
Could be a good thing.
Page
Yeah, to
6
get there
just
first,
gives
so.
you some more than, we've represented everything
Right.
graphically. These are just the numbers. Nothing new here on page 6. The last couple pages are just some stuff about Milliman, some caveats. Any questions on the police pension? Okay, next moving on to the municipal plan. Again, much of the same story, with the exception that the contribution did not, well, again, it went up, but it went up by a little bit more than expected, and I'll get into that, into why in just. On page 1, we got the active membership. Now, the municipal plan is closed, has been closed for many years, so no new employees are entering the plan. That way, therefore, you can see in the bottom left-hand corner that age service distribution is more concentrated towards older employees and longer service employees. So this plan is much more mature, getting to it's a different part of the life cycle of a pension plan. Within time, a good portion of the people here are eligible to retire right now. They haven't, and that's caused some adverse impacts on the liability, but it is a very mature plan. There were 2 retirements during the year. There were 7 retiree deaths as well.
So still their beneficiaries still get. payments,
5 of
right?
them did not have a beneficiary.
Oh, they did?
2 had
Okay.
had a surviving beneficiary.
And do most people take 50% survivor benefits, or do they take 100,
I don't know off the top of my
Yeah,
head for this plan,
just
but
wondering.
yeah, it depends. Page 2 is a very, very, very similar story to the police pension, so I'm not gonna spend too much time on that. Numbers are different as far as the dollar values, but the stories, the percentages are all the same. Page 3 is identical. It's the same because the plans are all invested exactly the same, so the story is the same. I'll skip on to page 4. And so the accrued liability grew from 55.2 million last year to 55.6 million this year. We expected the accrued liability to stay at 55.2 million at a flat amount, so there was about a $400,000 loss. That was mainly due to higher overall pay increases than expected. It was primarily a handful of people, not across the board, but a chunk of people that had a higher pay increases than expected, drove the liability off. And while there were 7 deaths during the year, there were still fewer than we expected there to be. Therefore, there was a slight loss as a result.
So this plan's closed,
Yes.
people are retiring. So they're not necessarily, as less people are in the plan, there's gonna be less people contributing to the plan. And it's at 56%, so is that like not good?
It's not a great place to be, given the maturity of the plan. You know, ideally, when the last active person retires, the plan is 100%, and you live off the trust for the rest of the lifetime of the plan. Because you no longer have any people in the plan working for the town, but you're collecting taxpayers to put that bill, right? So that's the ideal world. It's not necessarily the world that any municipalities are in. I mean, the town of Avon has had no active employees for about, they're down to 2 actually, and they're about 60%. They're in the same boat as you guys are with.
So they're
less
just having
active-
higher annual contributions
Yeah,
into it to support it.
Exactly. So, you know, you want to be better funded, you know, but it's in these uncertain times with the market volatility, there's only so much you can do. Once the active employees all retire, the plan becomes much less volatile because you just have retirees at that point in time. And retirees, they either live or they die. Put it bluntly.
Plus cost of living adjustment.
Plus small cost of living adjustment, but it's much less volatile population, much more.
This group doesn't have. cost of living adjustment.
Oh, you're right. It does.
No, they don't.
They live or they die.
Okay, yeah,
put it
I
bluntly.
don't either, so.
So, you know, it is easier to make up that once you get to that point. Okay. Moving on to page 5. The contribution, again, so you can see the normal cost component up top. Did shrink because this is a closed group and the active population is getting smaller. So as it gets smaller, we expect that component to shrink, but it didn't shrink by as much as we expected it to. We thought that would go down to 180,000 if everyone retired according to our assumptions, but people are staying.
Yeah.
So the active count is a little bit higher, therefore the normal cost component is higher. The past service costs, the amortization of the unfunded accrued liability is right where we expected it to be. So overall, the contribution increased from 2.7 million to 2.9 million. We expect it to be about $30,000 higher than it is. So nothing material. That's mainly due to the normal cost component and people and active people staying longer and earning more benefits. And that's it on the municipal pension plan. Any questions there?
What do we use for an amortization period?
11 years, we're at 11
11
years currently.
okay.
Declining, it'll keep
No,
declining
it's
steadily
declining,
each year.
okay. A couple times we've adjusted that back up, right? I think we
Yeah,
got to
well,
10 and we went
yeah.
to 13.
Right, so, you know, increasing it helps us to relieve budgetary pressures in that
Right.
given year, but you know, it's.
Kicks again.
Oh, yeah,
down
this
the
kicks the
road.
can down the road. And, you know, pension funding is a simple premise, pay now or pay more later.
Yeah.
At the end of the day, right? So we're gonna talk about, probably, like I said, next year we'll talk about different funding methods. Rather than just increasing it, let's think about something else that can help to pay down the unfunded liability.
Or
in a
we could
reasonable
just keep it
period
at
of
10,
time.
right?
You could keep it at
10 for a
10-year,
while.
10-year open,
Yeah.
if you wanted to as well. So we can look at some options there.
Mhm.
All right. Last but not least, the administrative employees plan. This plan is down to 3 active employees.
Like 2 right now.
What?
One of these retired. this
Okay,
year,
as of
so
July,
that's
that's 3.
great.
So down to 2.
No.
So not much, given this, the population size is, you know, not a lot of activity, don't expect much activity year over year. There was 1 retiree death during the year. Page 2 again is very similar to the others. So I won't belabor that point. Likewise on page 3, skip over to page 4. So the accrued liability decreased from 13 million to 12.7 million. We expected it to decrease down to 12.7 million. Again, not much happened. We didn't expect much to happen. So this plan basically kind of fell in line with what we expected.
People got to be a year older, so.
Yeah, everyone got a
they
year
less money.
older. Yeah, that's it. You know, given the maturity of this plan, there's less growth in the benefits. It's just mostly retirees, and they're usually getting a year older, so the liability is expected to start declining. And then moving on to page 5. Again, the actually determined contribution grew from 794,000 last year to 830,000 this year. we expected it to be 842,000, so it was a little bit lower than expected. And it's primarily because of the funded ratio improving due to the asset returns and the liability staying fairly flat. Therefore, all components of the contributions were slightly lower than expected.
Yeah, 11-year amortization period for that.
Yeah. Yeah, I'll treat them consistently. Probably when we have the conversation about amortization periods in the next year or so, we might start treating the municipal plan and administrative closure plan slightly different than the police, given that the police is still an open and accruing plan. Very different demographic profile, different characteristics. So we might want to approach some things a little bit differently potentially. We can talk more about that next year. Are there any questions?
I don't think I was ever here for one of these meetings. Is this once a year you do this?
This year, yeah.
Okay.
And UBS mentions maybe coming back with some recommendations on asset allocation. To the extent there are some changes, we'll take a look at that and see how that may impact the interest rate assumption, and what based on the capital market assumption.
Awesome.
That's all I have.
Thank you.
Yeah.
Good job. Usually we don't see that much. Well, I don't know. Sometimes the prior presentation has been smaller than, sometimes Becky, I don't even think Becky comes every year, right?
We had that gentleman last
Yeah,
time.
Kai Peterson.
Yeah.
I think they definitely heard about the bid outcome. Just with everybody here and everybody, the data that they had too, that was pretty good.
Yeah.
Thanks.
Nice
Thank
meeting
you.
you.
Thank you.
Look forward to working with you.
We'll talk to you soon.
All right, cool. That was great. So, all right, we're moving on to remarks by committee members. Does anyone have any comments about the presentations tonight?
Nice to see Lockton step the game up.
We told them. And if there's anything you guys want to see, please let us know.
Okay.
And we'll make sure they give it to you.
Yeah, because all that data that they had in the background that they brought that at the last RFP response. I never saw it after that. Well, oh, here's all this cool data we'll show you. And then they never showed it to us. So it's nice that they put it in there.
I mean, and he's got a point. There's nothing you can do about it, but it's interesting to see where it's going and what's causing it.
Well, eventually, negotiations, you could try to do something about it. It's not easy with the unions, but
You guys just get PAs, that'll be a victory.
yeah.
Nice. I'll just apologize for being late again, guys. It's really my bad. Like comments there. Anyone else? Yeah. All right. We'll move on to setting the next meeting. Janet, do you have a date in mind?
I do not. I'm throwing it out. We usually try to do it every quarter, so that would be 3 months. That'd be August.
August.
How you guys all feel about August?
I want to say I could
Okay.
do mid-August if that works for everybody else. I think late August is
Wait,
not like it's
late
something
honeymoon or something? A long honeymoon around the world?
something like that.
I just
What?
graduated, so I have no idea. Right now I can do mid-August, but I'm going to be job hunting, so I have no idea what my world will be like then.
So what I'll do is I'll send out an email to the group at large.
Mhm.
I'm looking for what Mondays in August work.
Did you say Monday?
Yeah, that's usually the day that we do meet.
Okay. All right. 'Cause
Monday's not good.
yeah, no, I'm okay on Mondays. It's just the last 2 Thursdays I'm not available. So Monday will be fine. Thank you.
Yep.
Alrighty. Congratulations on graduating, Janet. It's nice. But all right, at this point, I'll entertain a moment. I'll entertain a movement to adjourn.
I so move.
Second, I guess.
Yep.
I don't know these pros. Good luck on your wedding.
Hey, I really appreciate it, guys. Yeah, it's gonna happen one way or the other. All right, cool. Well, other than that, then I guess we are all set. I appreciate everybody coming tonight, and I'll see you next time.
Take care. Thank you.
Bye, everyone.
Bye.
Night.
Here's a spare one of the Lockton decks. I've already got one printed in the one they gave me.